Video, as always, Scott Carson, jacked up to be with you today. And today's special episode has a special guest. Now, we all can agree, especially in real estate, when you're looking at deals and you're marketing for stuff and you're looking at assets, whether it's notes or property, stuff like that, you get going, get rocking on. There's a bit of rhythm to what you're doing on a week in, week out basis when it comes to your marketing and raising capital and putting the deals together and turning those properties or those assets, stuff like that. That's great. And anytime you can build that kind of rhythm into your business, it makes things a whole lot easier when you're in sync, and especially in sync with your vendors and other things that are going on. But most importantly, you got to put your money into rhythm. You got to put your bookkeeping, your accounting into rhythm. And today's special guest is somebody who's got years of experience, not only working Fortune 500 companies, but also working for the federal government. And he's here to share a little bit of insight aspect of some of the things you can do as an entrepreneur, especially this time of year, to save taxes, but also after April 15th, so you can start doing a little bit of your tax planning. Now, who am I talking about? Well, he's a certified public accountant and tax strategist that serves clients virtually all across the world through his company, Rhythm Accounting. All right. He helps business owners, real estate investors, and high income individuals use the tax code to build wealth. And we are honored to have Ronnie Goode joining us here today. Another guy, amazing individual that we actually met at FinCon a few months ago. We're honored to have you on the podcast today, Ronnie. How you doing, man?
Hey, I'm doing pretty good. First of all, that was an amazing intro. You've been doing this for a while, but I'm doing well, man.
Well, good. Well, I'm available for birthdays, Christmas parties, bar mitzvahs, whatever you need, man. I'm available for intro.
I hear that.
That's the radio DJ or the wannabe, the ESPN sportscaster back in college coming out and here on the podcast.
Oh, you got it.
So let's talk about this, man. How'd you get into what you're doing? And I know you got a degree and stuff like that. We talk about more about that, but we'll dive into some meat and potatoes. But kind of what led you to where you're at today to work with entrepreneurs.
Oh man, I'll tell you what led me into accounting. First of all, I went to college, and just like a lot of young, teenagers, they don't really know what they want to do. So I went to college. I was kind of scrambling around a little bit, trying to figure out what I was going to major in. Should I major in computer? Did I do business management? I had no idea what I wanted to do, but I had someone that saw, I guess, something in me at that time. And I was totally different than I am now. I was a little kid, but he saw something in me. He was like, Ronnie, do you want to be in these classes? Do you want your resume to go across the board, in a company with these other folks that you see in these classes? And at the time, no disrespect to my football players, I was in there with a whole bunch of football players that didn't care anything about business. He was like, that's your competition. He said, unless you get into accounting. I was like, all right, this accounting thing. He kept telling me over and over and over. Then eventually he kind of, persuaded me to check it out. And I didn't like it in school. I'll be completely honest with you, but it ended up working out for me.
Well, but that's the beautiful thing. We end up growing up, and a lot of times, and I had a business degree, from Texas State University back then, and I understood the numbers, but I didn't do very so well in accounting classes. You know what I mean? I was like, I need to do something else. I can't sit through 4 years of college on this stuff, but I'm glad there's others out there that I can delegate and find out, like yourself, to make things happen, right?
Yeah. No, it was one of the best decisions I've ever made. Like I said, in college, I didn't think it was a good decision, but after college, I was like, oh, okay, this is how the world talks when it comes to money. So I love it.
Yeah, especially when you're, and it's not fair, it's one of the most biggest things you need to focus on is your books. And there's so many, everybody's always so afraid to pay more to Uncle Sam and in that dreaded 3-letter word we won't mention them because we don't want to hear about this. But, there's a lot of great things if you set things up or manage your money, i.e. put a rhythm in place, the rhythm of the music, the rhythm of the money, that can come out doing really well. And you're kind of busy right now because it's the first quarter of the year, probably your busiest time of the year right now, huh?
Yeah, this is a very busy time for us. We're in tax filing season, tax preparation and filing season. Just remember, this is the time from January through April where we have to report on the activity of the prior year. Okay. But I just want to put this out there just ahead of time. Taxes aren't over, after tax filing season. You still got planning after that. And that's where I think a lot of entrepreneurs, especially my real estate investors, I get a ton of those, I try to push them into more planning because that's where you get to take advantage of the tax code.
Where do you see is probably the top 3 places that people need to plan a little bit more when especially comes to investors out there? Because our audience is a mixture of folks that are working in their W-2 job, but also part-time investors. And of course, the other half is full-time real estate investors.
Yep. So the first thing I would say is make sure you want to have your numbers together. A lot of people come to me, they actually, Ronnie, what can we do? Can we do anything about this? Hey, I paid this much last year. I don't want to pay this much. And it was a surprise. That I see that so many times where it's a surprise tax bill. And nobody likes surprise tax bill. It's like a car repair that's a surprise bill. I hate those things.
Right.
So it's always a surprise. In the first place, I tell them, I'm like, okay, so let me see your numbers. And it's like, well, I don't really have it together at the moment. I can piecemeal it or send you some documents. And me personally, we're not putting any documents together for you. We want you to give us something that we can read and interpret and understand. So it starts with the numbers. Get your numbers nailed down, because a lot of people miss out on deductions. They miss out on planning opportunities. They miss out on tax saving opportunities because they don't have their numbers in order. So that's the first thing. The second thing I would say is that year-round planning is a game changer. Year-round planning. So if you're only talking to your CPA tax professional once a year, you are doing yourself a disservice. Okay. You are doing yourself a big disservice. This should be a regular, ongoing conversation throughout the year because you got to get more to being more proactive than reactive. Tax filing is reactive, tax planning is proactive.
Yeah, that's definitely true. If you're just waiting until once a year to have them sign off and stuff, you're missing out totally on that. I often think I don't know if you're a fan of movies, stuff like that, but I always think of Denzel Washington's movies, American Gangster, and is a story about Frank Lucas and how Frank Lucas would have breakfast every morning with his attorney and his accountant, or meet with him at least once a week, how to figure out how to do so. Not that we're trying to put you in anybody in the heroin trade, you know what I mean? But that's the relevant of taking his numbers and how, if you look at how he was able to diversify that, and a lot of us investors, we have a multi-amount of property. We've got a ton of stuff that we can write off, but sometimes it's just not knowing what we don't know. And following the 5,000 or 7,000 pages of tax code is not for us to understand.
Yeah, the tax code, I always say it reads like Shakespeare. It's a lot of where, far, our, thous, so when you're reading it, you're like, I don't know what this thing is talking about. Then a lot of folks try to go to the IRS website to help them interpret what they're saying. They still can't get it. So you really want to work with somebody that does it for a living, that's living this stuff. And just to let you know, even though it's about 5,000 pages in the tax code, when you work with a tax professional, we only specialize in specific areas. So I work with business owners, real estate investors, because the tax code is so huge. I get farmers that come to me sometimes. I'm like, I'm not the best person for you. You need to go someone that specializes in farming. As it relates to real estate, there are so many things that are specific to real estate investing that you need to know. And your general kind of tax professional may not know it if they're not specializing and focusing on it.
Your bookkeeper is different than a CPA. Your bookkeeper's putting the numbers
Oh,
in
my
place.
Lord. Yes.
And a lot of
Yes.
people screw that up, don't they?
Yeah, let me just touch on that real quick. So your bookkeeper is going to help you be financially organized. Okay, their job is like a financial admin, so to speak. They may have accounting skills or they may not, but bookkeeping and accounting traditionally are two different functions. It's just so nowadays with technology, QuickBooks and things like that, they kind of blend it a little bit. But accounting kind of goes into more of the interpretation of the numbers. So you are financially organized, then your accounting going to run the reports for you and interpret what's happening so that they can explain it to you in a way that you understand so that you can then make decisions. And then your tax advisor, strategist like myself, we're going to come in and say, okay, here's the more tax efficient way to do what you're already planning on doing. So that's how they kind of play together. You may get lucky and find all three functions in one place, but that's not always the case.
Yeah, that's the truth. Well, a jack of all trades is often a master of none in a lot of cases, too, as we like
Ooh,
to say. Now, with the
come
code
on.
always changing, how do you stay on top of the different changes to the tax code?
Yeah, so we're on it daily. So I got alerts. I subscribe to certain publications. I subscribe to the IRS, alerts that come out. They send me direct information about what changes are happening in the tax code. And I'm glad you mentioned that because right now they're kind of in Congress working on a bill, or at least Congress agreed on the bill, right? That could potentially impact your taxes for 2023. So you're starting to hear people say, hold off on filing your taxes. Don't file them as quickly if you're one of the earlier folks, which not too many people file too early, but kind of hold off on it.
I think
Just to be honest, right?
I think the only people that file early are those that work full time and they want to run January 1st and get their tax refund. You know what I mean? And
Yeah, exactly.
they're not even waiting for their W-2 to come, and they're taking the last pay stub on January 1st and say, "Hey, let's do my taxes so I get my refund back." And I'm like,
I want their refund.
Yeah, you just gave the government an interest-free loan for 12 months. You know what I mean?
Oh my Lord. And I have to repeat that every single year. I'm like, you overpay them, so they're just giving you your money back. That's it. That's all. They will never give you an interest-free loan, so don't give them one.
No.
Never pay the IRS what you're legally required to pay. Don't leave them a tip. That's all we're talking about at the end of the day.
Wait there. There may become a mandatory 18% service charge on the bottom, like we see everywhere else.
I know, right? You want to be careful. It's a lot of stuff that's happening. It's politically charged, to be completely honest. But to get back to the point on that bill that's about to be passed, they started off like $100 billion bill. I think it went down to 78 billion that they agreed on, but it has tax breaks in there. So two of the main tax breaks, what I'm seeing that can potentially help my clients, one is to the child tax credit. And this is coming from the Democratic side. They say they want to take care of, folks with children and give them an increase and expand the child tax credit. Now, from a business owner's perspective, and the majority of my clients are business owners, real estate investors, they're talking about 100% bonus depreciation. Okay, so bonus depreciation, and we can get more into that. A lot of my clients benefit from bonus depreciation. Okay. So those are the things to kind of look out for, as if this bill kind of, gets passed. But it's agreed upon in Congress. So I think that's the hardest hurdle to overcome.
You mean they got them to agree on something before they shut down the government?
Finally. Finally.
See, this is the thing that always cracks me up about it, how we have to have an emergency meeting to avoid a government shutdown. And like, how can they sit there with a straight face and tell us that we need to be accurate with our books and stuff like that when the government can't control that? I know that's a whole different podcast and a whole different episode. It's just this hilarious.
Oh my Lord. I have a lot of feelings about that, but I'll digress.
So you mentioned bonus depreciation. Can you explain that to the layman who's listening?
Yes. Yeah, so let's just start off with just depreciation by itself, right? So depreciation, for those who don't know, is basically a deduction that the government gives you to account for the normal wear and tear of an asset. So we have assets and, over time, assets kind of wear out a little bit. So if we're talking about properties, like rental properties, it's going to rain on it. It's going to snow on it. The weather's going to get to it. It's going to wear out over time. So the government understands this and they give you a deduction for it. Now they assign lives to these assets. They call them useful lives. Like a car is like 5-year property, or residential real estate is 27 and a half years, and commercial is 39 years. They give you the lifespan in which you can take a deduction for the useful life of that asset. So that's what depreciation is. Now, in some instances, you're able to accelerate depreciation, meaning you can get more of a deduction for it ahead of time. And bonus depreciation is one of those things that allow you to accelerate the depreciation.
So when you're talking about that, instead of 27 and a half years, what are you deducting? 2 years worth of deduction, 5 years of deduction at a time? Is there, or if you're putting a new roof on, you deduct that in a different aspect of things? Can you dive a little bit deeper into that?
Yeah, great question about that. So I'm talking about 100% depreciation is a year one acceleration of depreciation. 100% in year one. So imagine you have a property that you just purchased, $500,000 property. And typically if it's residential, you're going to have to, write it off over 27 and a half years. So you'll get a portion of that over 27 and a half years. But imagine you're able to accelerate that depreciation and get all of your depreciation deduction, at least for the components of the property, in year one. Now, the structure of the property, you still have to depreciate that over the 27 and a half years, but the components of it, those are year one bonus depreciation if it's at 100%.
So components, you're talking like the electrical, sheetrock, wiring, ceiling fans, paint, carpet.
Yeah. appliances, carpeting, all of that good stuff. And it makes sense, right? And you may hear this if you're in the real estate world. For the folks out there, you may hear cost segregation studies,
Yeah.
right? Cost segregation studies is just something that an engineer does to a property where they kind of break down the multiple components of the building. So it's not just the building as a whole. The building is made up of all of those components that Scott was just mentioning. And those components have an even shorter useful life than the overall building itself. So if I got a shorter useful life, that means I can take a larger deduction earlier than later.
Mm-hmm. But you're going to
Stuff.
miss out on deductions later on in further years, though, correct? If you take a bigger one in the front end, you're not deducting 1/27 and a half of it. You're basically, if you took 5 years, you're kind of stuck, Chuck, with not being able to take the deduction for another 4 years. Would that be accurate?
Yeah, that's an amazing point. Now you miss out on the depreciation on those components now because you took it all in year one. So you got this huge hit. You got these huge tax savings. As soon as you got the property, you're living large. You might even got some money back, because you overpaid the government, right? So you're living large and you may have some losses that carry over to the next year. But for the remaining years, you're only still depreciating the structure. And that's a much smaller percentage of depreciation than you would if you would have spread it out over time. So this is where we get into the conversations about tax planning. You want to think for the now and the future.
Mm-hmm. So I can see that having a lot of advantage, especially if you're like a fix and flipper, or you're planning on flipping assets every 4 or 5 years, or doing a 1031 exchange from one asset to another, trying to take advantage of appreciation. Maybe would that be kind of a good example? But if you're a long-term hold, buy and hold, then you probably don't want to take that extra depreciation on the front end, right?
Yeah. So let me say it like this. So if you are a buy and hold person, so that means you invest in like rental properties, you're a landlord, so to speak, even if you have someone else managing it. Typically with landlords, you get depreciation. Now, if you are in the fix and flip game, a lot of folks kind of in fix and flip game. You have to be careful with fix and flips because it's handled differently in the tax code than just a long-term rental, especially if you are in the business of flipping properties.
Sure.
So if you are in the business of flipping properties, you want to avoid the real estate dealer status, because if they deem you to be a real estate dealer, now those properties that you're acquiring, it's treated more like inventory. So you no longer get to depreciate those things. Okay. And you don't get the long-term capital gains treatment from selling it in the profit. So, you want to kind of think about that. So it depends on how you're approaching it from a real estate perspective to determine, which strategies to implement. Great questions, though.
But it makes sense to hold on to that asset for at least a year, basically, so you don't get that short term.
You want to hold on for at least a year, just so you can get the long-term capital gains. And just for reference out there, if anybody's thinking, ordinary income or short-term capital gains, basically ordinary income rates can be taxed up to 37%. Just by having an asset and holding it for more than a year, that's taxed up to 20%. Okay, so you already, by holding on to it, you drop about 17%, in taxes. So just you want to be tax smart when you're making decisions.
Yeah, that 20% is a big difference. That's
a huge difference.
Huge difference when you look at the fix and flip side, or does it make sense? And we see that in the note business, obviously, side where we buy distressed debt. And that's why I tell folks, especially when we buy stuff that's non-performing, and we work to get the borrowers back on track. And that's one of the biggest things. Like, listen, do not do a permanent modification right off the bat. It becomes a short-term capital gain on that aspect. Do a trial payment plan for 366 and one extra day, so you get that 1 year before you modify. Because it's so weird how the government, if you modify it, they want to tax you for the modified amount, even though you haven't accumulated that stuff. And of course you can file a third-party amendment to it to bring that value down, which we end up doing quite a bit sometimes for different investors. But it's just an extra thing to keep in mind. Uncle Sam has got his hand in a lot of pies, right?
Uncle Sam has his hand in a lot of pies. So you just got to play the game to win, because it's available to you. And the government actually wants you to do some of these things because they incentivize certain activities that we do. They incentivize business owners. That's why we're able to write off a whole bunch of stuff. They incentivize real estate investors. That's why we're able to write off a whole bunch of stuff, real estate investing. So you just want to play the game the right way and use the tax code to your advantage.
That's kind of like going from playing checkers to playing chess.
It's all about playing chess and being strategic about it, because if we think about it like this, right? Taxes are probably your largest expense when you really think about it. You got income tax, we got self-employment tax, FICA, Social Security, we got property tax, all in the list goes on, right? So if you just add all of that stuff up, you'll see that taxes are your largest expense. They are. So what you want to do is plan for taxes, or taxes will plan for you.
Exactly. It literally makes me think of the Ben Affleck movie, The Accountant, when he's sitting down. That's a great movie. It's a little violent, but it's a great movie when he's sitting down with the folks that own the farm. And like, well, do you have a small business? Do you do some crafts? Can we? Oh, we can find a deduction for that. We can take that off your taxes. And they're walking. You can come. You're like our firstborn in a lot of cases, right? I'm sure you get that with some of your clients. They walk in kind of sad, and then they walk out. Hey, it's good to be Ronnie Goode.
Yeah, they walk into my office like, Ronnie, first thing I ask them for is, like, give me your prior year tax return. I just want to see what happened. And a lot of times what people will, especially for the folks that are making money, a lot of times what they'll see is they'll be like, yeah, well, I only owed them $7,000 this year. And I'm like, no, look at your total tax line. You owed them $7,000 more dollars. Right. That's the reconciliation. You owed them an additional $7,000. You really paid 30, when you look at that total tax line. So once I get them to see that, then their eyes kind of open up. I'm like, all right, now you're on my page. What can we do about it? Let's start talking about some things. Let's, like the accountant. Hey, you're in the business. Are you planning on doing any of these things? Because those things are more tax advantage.
What are some of the easiest things that people can do? Well, so let's talk about entrepreneurs. Let's not talk about folks working full-time right now, but let's talk about our full-time entrepreneurs, real estate investors, business owners. What are some of the easiest things that they can start doing that you see people miss out on? Are we talking maybe like retirement accounts or some basic deductions? What are some of the things that you're like, this can have immediate impact on this year that maybe you didn't do last year?
Yeah, so the most easy thing will always be retirement accounts. That's the easiest thing that everybody kind of understands. Okay, I make a contribution, especially if it's a pre-tax account, right? Make a contribution, I get a deduction for it. I pay taxes later on, but there are some things you can do about that. But I get a deduction for it that lowers my taxable income. So you can kind of, play the game with those retirement accounts. Those are the easiest things. The next level, what I would say for my business owners, there are a ton of different things we can do. So what I like to tell business owners to do is to think more like trying to make those personal items in your life, find a business purpose for it. Okay. When you're able to find a business purpose for those personal things in your life, you can write them off. Now, how to write them off, there may be some, differences in how to write them off, but now you got them into the bucket where we can have the government give us a little discount for those things. So that's what I like to kind of say. And that's all kinds of things like cell phones, iPads and, cameras. I do a lot of content now. So I got cameras, I got all kinds of stuff. Even when I travel, you know what I mean? When I travel, I wrap a weekend. I'll travel, let's say I want to go to Florida. I like to go down to Miami from time to time.
Amen.
Go down to Florida. I'll do business on that Friday. I'll do business on that Monday. That whole weekend that I'm there though, and I'm having fun, I'm at the beach. All of that is considered a business trip because I wrapped the weekend. I was just being more tax smart about it. So I like to kind of do that, how to make more things that are personal, find a business use for them in your business.
Yeah, that makes a lot of sense. And then it also too depends on kind of how you're filing, right? Too. I mean, like when I've been a public speaker, there's things I can write off like suits and Robert Graham shirts and stuff like that because I'm public speaking. It's part of my image. But if I'm just a normal guy, I can't go write off my $100 shirt that looks good on me on a Friday night. You know what I mean?
Yeah, you really want to be smart about it. So it's an advantage. And one thing I like to kind of level set, all of my folks listeners, like, I don't want to have a business. I don't want to be an entrepreneur. I'm like, where there's an opportunity there though, you may do something, even if you do something on the side, you don't even have to be full time. You get to open up the tax code by even being part-time or having a side hustle. I got folks that drive lifts and all of that type of stuff, and they're able to take the same types of deductions in their industry that other folks get to take in their industry. So it's so many things you get to do, but just think about this one thing. When we want to compare business owners to employees or just W-2 employees, think about it from a W-2 perspective. It's just 3 steps. First thing you do, we make money. We work our hours and we make money as a employee, right? The next thing that happens is you pay taxes. The last thing that happens is that you get the money that's left after taxes. Okay, so you don't get that gross, you get that net, right? Now compare that to business owners or side hustlers or entrepreneurs. Entrepreneurs make money. That's the first step. Second step, they pay bills. They get to spend the money first, and then they pay taxes. So Uncle Sam doesn't get to touch it until business owners are done paying for the things or reinvesting in the business and doing the things that they want to do. That's the major advantage of having a business or being entrepreneurial versus solely being a W-2 employee.
That's one of the things when I'm talking with folks and students that are, hey, I want to leave my job. I'm like, that's great. Don't do it overnight. Let's put a plan of action in place. And what number are you making right now? What's that number? Well, I got to make this per year because that's what I'm making. I said, well, you got to think this a little bit. You may not need that much because the minute you become, if you're a business owner, you're not paying FICA before you. In a lot of cases, it's a different animal. And he's like, oh yeah, I could probably do about 20% less. I'm like, hey, you're closer to the end line already for you. Now, a lot of folks too talk about wanting to put their kids to work and having their kids be a part of their business. What are some things that people can do to hire their kids or other things they can do to kind of write some of that income off or pay their kids at an early age to maybe to reduce their tax accountability?
Yeah, so I love the hiring your kids strategy. And I personally don't have kids myself, but I see the transformation in a lot of my clients. Hiring the kids is one of the best strategies that you can utilize. And the reason why is because it shifts income from your business to your kids completely tax-free. Think about it like this. Your business get a deduction because it has to pay the kids, and your kids get the income and they don't have to pay taxes on it as long as they stay below the standard deduction. In 2023, the standard deduction was like $13,850. That's a lot of money for a kid, right? 13,000. I wish I would have had a 13,000 sometime. My chore money was much lower than that, right?
Right. I mean, it's like over. That's a
Come on.
It's a 11. Was it $1,100 a month roughly? I mean, that's looking
Come
pretty good high on the hog.
high on the hog, right? So if you had a business where you're able to pay the kids and stay below that standard deduction, if of course they have to meet, other requirements below the age and all of that good stuff, then there's no taxes at all. Now, if there's no taxes at all, what can they then do with that money? Now, your kids have money for, they can use it on some school things if they want to. They got, some things for that you were going to pay for them anyways. You're going to buy them some clothes and things like that. They can use their own money to do that. Or the thing that I like to kind of maximize the tax saving and wealth building is have them invest some of it in a Roth IRA. I love that because now they have earned income from working in your business, and now they can invest. Now it's like $7,000 you can put in there in 2024, right? And they can start that compound interest for the folks that love the stock market, and they can get that rolling now. Compound interest. If you put it in a compound interest calculator and you project it out, that money is gonna quadruple. So I love that particular strategy. So to answer your question, though, what a lot of my real estate investors, they have their kids help out with their real estate, especially the ones that are managing their properties, because there's benefits to managing your own property, especially if you're trying to do cost segregation studies and, short-term rental strategies and things like that. So they have their kids kind of help, with some of the cleanup and things like that with their properties, and they pay them a legitimate wage. It has to be fair market, right? But they set it up properly and you pay them and they help out with the rental property. So I love that strategy.
Yeah, I know one buddy of mine, he has his kids come out and mow and weed eat and stuff like that. And he creates an invoice and pays the kid the invoice, and immediately it's signed over and then go and put in the Roth IRA. The kid's like, ah.
It's beautiful though. It's a beautiful strategy. It is, especially even if the kids can't see it now. When they become an adult, they be like, thank you, mom and dad, for doing this for me.
Yeah, and that's the thing is, if the earlier you get your kids in and reading about money, that was one of the great things about FinCon is meeting a lot of folks that are really focused on that financial education for the youth, because it just doesn't take place in the high schools. To sure that doesn't take place in college unless you're actually searching for it or majoring in it in a lot of cases. So there's a lot of great advantages doing that and getting that money rhythm started quickly at an early age, right?
Got to get in that rhythm.
Exactly. What's maybe the most overused or fudged write-off that you might see people trying to take advantage of, if you could say, or one, two, or three, top of a couple there for it?
I got a few, but I'll do the big one. The big one is everybody tries to write off their car nowadays because it's popular online. If you're on the TikToks, you're on the Instagram and all of that stuff. Everybody's trying to write off cars, and they're not. They're messing it up. Just to be completely honest with you, they're messing it up, and then they come to me, and IRS sends them a letter, a notice, and say, "Hey, can you explain this?" It's like, Ronnie, what's going on? I need your help. I'm like, you didn't talk to me before you tried to implement this, so I don't have good news for you, but
Right.
I can talk to them on your behalf to try to get some things reduced, like some penalties or something like that. But you made the mistakes, so you got to file an amendment for that and kind of pay that bill. But the car write-off, a lot of people are now trying to write off, G-Wagons and all kinds of cars, because it's marketed heavily online.
Right.
And
Right.
it's only reserved for specific groups of people that it applies to. But the problem is everyone think that they can do it, and they don't have the business to justify such a deduction. If
Right.
you have the business to justify such a deduction, and your business, you can find the business use for this type of vehicle or a vehicle in your business, then go ahead. Yeah, let's do it. I have plenty of clients that buy vehicles, because they need it within their business.
Mhm.
But if you don't need it within your business, but you're hunting for a tax write-off because you heard some guy online say, yeah, you can do this. Oh my God, that's the worst thing that you can do. I see it all
Yeah,
the time.
I see it. The Instagram famous. If you're taking your accounting or investing advice from an Instagram account, and that's all that they got, you ain't doing so good.
Oh my Lord.
I was cracking because there's a new documentary out on Netflix called Bitconned about a couple guys that were down in Miami. When you said Miami, made me think about where
Mm,
they moved down there from New York, New Jersey, and they bought these high end cars, Lamborghinis, Rolls Royce,
mm,
and they were renting them out. They were literally renting them out for like video music videos or stuff like that,
mhm.
which I could see that making sense. But they're out driving them all along and looking fancy and stuff like no, no, no. You might be able to deduct the mileage that you're putting in for your job, but that's not deducting the G wagon, right?
Right. And you see that a lot of times where there's a heavy personal use on this vehicle,
Yeah,
but they're trying to write it off as like 100% business use. And you just can't justify that. So when I get people that come to me all the time, it's like, I'm thinking about writing a car off in my business. I'm like, all right, let's have a conversation about that. And for some folks, trying to just write it all off in the first year or something like that may not be the best approach for you.
mm,
Mileage probably is the best one, depending on your business, depending on
right,
what you have going on. Tax planning, and I say this all the time, is specific to that person's situation. So what works for John down the street may not work for Ronnie. You know what I mean? What works
exactly.
for Scott may not work for this person. So it's very specific to that person's situation. So it's good to hear about things and go. You want to hear about something, then go ask the tax professional. Don't hear about it, then try to execute it, and then go to the tax professional. Like, can you help me clean it up? That's never a
Mm-hmm.
good thing.
What
Yeah.
what what counsel would you give folks out there that maybe haven't filed their taxes in the past couple of years and they're just scared of, or they were at a spot financially they couldn't pay taxes, or they had COVID kick in or something like that? Obviously, that stopped them from
Yeah.
making money. What counsel can you give
Yeah.
them?
Yeah, that's great. A lot of people are actually in that position, and we've
Yeah,
seen that for the past few years. It's been a wild ride from a tax perspective, from a law perspective.
right.
With the laws that impacting us on taxes during tax season. It's like it's interesting. And I'll just say this one last piece. The IRS can't even adjust to it quick enough, to the laws. So
Right.
it's like, yeah, that law that came out, we're going to hold off on this because we're not ready. Our systems aren't ready. We're backed up. So you see a lot of that happens. But for the folks that have, tax returns that you haven't filed in a while, I'll tell you one thing that's very, very important. Your tax liability does not go away unless you stop the bleeding. Okay. So penalties and interest are a real thing. And if you don't at least get in touch with them about it, try to set up some sort of installment plan or something like that, it's going to continue to grow to this, outrageous case. So if you can't afford it, to pay your tax bill in the previous year, you're not going to be able to afford to pay it in a few years later because of the interest and penalties.
Right.
So the first thing you want to do is get it filed. Okay. Or go to your tax professional, say, hey, I got 3 years ago. I know. I got 3 years. First thing they're gonna look at you kind of funny because that's what I do. I'm like, 3 years, what happened, man?
Mm-hmm.
Just talk to me.
Right.
First thing they're gonna look at you, man, is like, all right, here's our plan. Let's get these filed back to back. Let's knock them out back to back. And once we get them filed, let's come up with these installment plans, to kind of get you some time to pay these things. And generally speaking, you have about I think it's like a 10-year period to pay a bill,
Yeah.
so you can kind of spread it out over time. And they'll work with you, but you have to have a conversation. You have to get in touch. You have to stop the bleeding. That's the first thing I think you should do. Stop that bleeding, please.
But they also, too, you hear a lot of the commercials about what is the Fresh Start program, where they allow the work with the IRS to avoid penalties or get some of that stuff removed, or set up a payment plan, basically. In a lot of cases, especially if you're below 50,000 in taxes owed, they'll work with you a lot better.
Yeah, you can actually do that online. You don't even have to call them for that. So it's only when it's above a certain threshold,
Right.
then they want you to talk to them. Like, kind of,
Sure.
let's talk through this thing. You owe us
Right.
a lot of money, you know.
Yeah.
But if it's like below $50,000, you can kind of go online and set up your own installment plan to kind of take care of that. And again, if you work with the tax professional, they're going to help you. Like, there are some instances where penalties can get waived.
Mhm.
Okay, so that's, so you want to work with somebody, just stop the bleeding. That's all I can say. Just stop the bleeding, because it's not going to go anywhere unless you do something about it.
Yeah, that's such a truth. We've had some of our friends and clients that faced that, and they were so scared about. Like, listen, just approach it. Start paying something. If you're paying a little bit, if
Yeah.
it's $50, $100 for your time, go online. It looks good if you've got to ever sit in front of those folks. So it's a good thing there for you. It's also important too
Yeah.
to make sure that your books and like your LLC docs and stuff, all that's in line with minutes and stuff like that too. Correct?
Yeah, all of that stuff. You want to have that in order, especially for my folks that have corporations,
Yeah.
because the rules kind of change once you get taxed as an S corp or your C corp. I don't see a ton of people in C corps. It's just a small percentage, but I see a lot of folks that have S corps, at a certain period of time, because they want to try to save some self-employment tax. But other requirements come with that. You might have to have an annual meetings and shareholder meetings, and you got to document your minutes and stuff. You want to run this thing properly. And typically, once you get to the S corp level, a lot of those folks kind of understand, if business owners, it's like, all right, S corps, we understand this is a legitimate business. As a matter of fact, you have to file a tax return ahead of you filing your personal tax return if you have a corporation. So the IRS recognizes it as a separate business from you personally. It's a little different if you're a sole proprietor or a single member LLC. You file in April with everybody else, and they attach a Schedule C, right? But when you have a business, from a tax perspective, S corps partnerships, they file in around March 15th, and then you get the K1s to file with your personal tax returns.
Exactly.
Yep.
Good, great stuff there. Who's
Yep.
your ideal client? I know you've got a variety of different clients that you work with, but if you could outline the folks that you work with, or maybe the folks that you don't work with.
Yeah, so my ideal clients are clients that are in position to save taxes. So they're normally in activities of entrepreneurship or real estate investing. They're doing the things that the tax code, favors. So I just help them accelerate those things, or find, ways to kind of take advantage of those things. I got a ton of real estate investors. It happened, 3 years ago. I'm like, where are all these real estate investors coming from? But I did, my family has real estate, so I kind of grew up around it. So I speak the language well. But yeah, for those folks that are involved in those tax advantage activities, that's my ideal client. Also, I'll say this last thing. The folks that have kind of solved the money problem. So I always say there's an inverse relationship between the money problem and the tax problem. We all kind of start off with a high money problem, and we're trying to figure out ways to make money. But as you start to figure that money problem out, it start to go down. What happens? That tax problem start to rear its ugly head, right? Because there's an inverse relationship. So the folks that have kind of solved the money problem, or are solving the money problem, and now have a tax problem, those are ideal clients for me.
Awesome. Now, you worked not only for a major 500 company, you also worked for the federal government.
Yeah.
Can you share a little bit of your time there and what you learned from that?
Yeah, so I worked at a public accounting firm, then I worked in Fortune 500 corporation, and with the federal government. So I was able to see kind of client service, commercial, stock, reporting to SEC and the government. So it allowed me to kind of connect the dots. So what I'll tell you about the government, government, all agencies don't do the best with managing the taxpayers' dollars. Okay. And I'm telling you this as someone that has, worked in the government. I can tell you that firsthand. And even if you look at some of the reports that they put out publicly, go to the GAO, the Government Accountability Office. Look at some of the reports they release. Look at some of the OI, Office of Inspector General reports. These are kind of the watchdogs, right, for the government. Look at some of the reports that they release, because they have to report that to us, because these are our dollars. And I'll tell you, If you just go read through some of that public information, it will let you know what's happening with the taxpayer dollar. So that was the biggest eye opener for me, with getting some government experience under my belt. I'm like, ooh, this is kind of bad.
It's always interesting when you see these agencies or stuff that have been given money and they can't account for it. Like there was an article that came out in Oregon about a month ago where they were given they couldn't account for $240 million in government funds for the rental bailout situation during COVID. They like, well, we don't know who we paid. We don't know how much we paid out. We don't know where it went and who got it. So we don't know. I'm like, yeah, somebody got their pockets greased a little bit there.
Oh my God. And think about some of the programs to add to that, like the PPP program and the employee retention credit. They had to stop that program because at a certain point in time, people could have still have gotten access to it. They had to stop that program because they was like, oh, it's just too much fraud going on with these dollars. And, people are taking full advantage of it. Not that it was hard to get in the first place. It wasn't a whole bunch of checks and balances built into the thing. So, who to blame? Do you blame, the people that kind of put it out and made it easy to take advantage of, or do you blame the folks that saw an opportunity? You choose, right? But yeah, it's just not the best use of our taxpayer dollars. I'm telling you, go to the GAO website, Office of Inspector General, just read some of that stuff. They have to put it out publicly because they have to report that to the taxpayers. Read some of that stuff. It'll make you a little angry.
Yeah. Just to say the bit. But hey,
yeah,
that'll make you angry and you can be scared about Uncle Sam the IRS. But the idea here is you, as an entrepreneur, shouldn't be doing everything on yourself. Shouldn't be trying to do your books accounting on your own. Is to hire somebody, a bookkeeper who can put it in place, but then bring somebody on like Ronnie here to help you read the rhythm of your money and help you get it maybe from being off tune to being crisp, I can't even say melodious. I guess a great melody. There we go. We're trying to say.
I love it.
When it comes to that, there, I'll have to edit that out. But anyway, what's the best way for our listeners to reach out to connect with it? Or should they wait till after April 15th to reach out to you because you're a little slammed?
Hey, that's a good question. The floodgates have opened. Let me just say that. Well, you can go to my website, www.rhythmaccounting.com. That's my website. I am on social media. I put out content every single day. Instagram, Ronnie the CPA. I'm on TikTok now. I don't fully understand it, but Ronnie the CPA on there. I don't post on Twitter a lot, but you can find me on social media. I'm on Facebook as well. Same thing, Ronnie the CPA. You find me on social media or go to my website, rhythmaccounting.com. I have, free tax saving guide. If you want to download that, it's a free tax saving guide. I got templates. If you don't have your books together, free profit and loss statement templates that I've created. If you have a business or sole proprietor, or if you have a rental property, free templates for you. So just go to rhythmaccounting.com. That's where you can find me.
Awesome. And we'll share that in the notes and also in the description below here in the video there for you. But Ronnie, this has been a big blast. I appreciate you taking time out of your busy, hectic schedule to come on the Note Closure Show and share some insight and some stories and have a good laugh about it. Because it's really the only time we can laugh about our taxes. Otherwise, it's a little
Thanks for having me, Scott. I appreciate it.
You're welcome. All right, guys, you heard it here. Go check it out, rhythmaccounting.com. Download those free templates that Ronnie put together. Book a call with him on April 25th. That gives him 10 days to recover after tax filing day for the most part. But that's the biggest thing. I think we've all been guilty of letting things slide or figuring things out at some point or another. It's important to take advantage of that opportunity, get back on track. It's always better dealt with it versus becomes a bigger issue later on. So go out, take some action, everybody, and we'll see you at the top.